Dan Mannix of ProVise Management Group, which is at 611 Druid Road here in Clearwater, is a senior portfolio manager who joined ProVise with over 10 years of experience across various financial markets. He holds the Chartered Financial Analyst designation, has a Bachelor's of Science in Finance degree from the University of South Florida. Now, I want to make it clear, ProVise Management is not a sponsor of our program. They neither endorse nor insult any of our comments or political opinions on the program. That's not his purpose whatsoever, because I presume political ideology isn't really very much of a concern for estate planning issues. But Dan has come today to talk to us about economic issues that I think really affect most or all Americans. His remarks are for informational purposes only and don't constitute an offer to sell or a solicitation to buy or a recommendation for any securities or investments or strategies. And his opinions are based on current market conditions as of today, subject to change. Past performance not indicative of future results, and all investments involve risk, including potential loss of principal. Unless, of course, you're the president selling cryptocurrency, and there's no risk. Consult with your financial advisor to determine how this information will apply to your specific situation. My two co-hosts today, both attorneys. Kevin Carey is also a former circuit court judge, and our Voice of Reason senior political analyst, Gary Gibbons. So quickly, Dan, explain to us the difference between a financial manager and a stockbroker, because you're not a stock brokerage house, even though you, of course, put your clients into equities.
Yes, absolutely. Thanks for having me, gentlemen. Appreciate the time.
Thanks for being here.
Yeah, so a stockbroker, as you would think historically, is someone who's going to dial for dollars, right? They're going to be calling anybody they can speak with to say, hey, we think you should buy this stock, and here's the reason why. Would love for you to do that using me, and I'll get paid a commission. I don't care what happens with the stock after that fact. That's your problem to deal with. We are fiduciaries. ProVise Management Group is a registered investment advisor, and we take a fiduciary duty for our clients. We are a financial advising firm. And so what we're doing essentially is we're saying, here's your financial situation. Here are the goals that you have. Here's how we're going to help you accomplish those goals. And we will use brokers in order to buy and sell different securities that are within your portfolio to help you accomplish those goals.
And to do that, you and the staff need a keen understanding of all issues economic, national, international, currency exchanges, T-bills, everything.
That's a lot.
Which is why we asked you in today, because I've seen reports that the U.S. dollar has dropped 12% in value over the past year, but we have 3% inflation. So kind of dissect that for us. What is that measured against, that 12% drop? I presume it's foreign currencies, but who determines what that currency is and how it's concluded to have dropped 12%?
Yeah, that's right. So what you're referring to is what we call the Dixie index. That's the DXY index, the dollar index. And so essentially what that does is it takes the value of a dollar relative to a basket of foreign currencies. More than half of it is the euro. So that's going to be the biggest chunk of what we're measuring the dollar against. It also has the Japanese yen, Canadian dollar, British pound, several different currencies. And so that's effectively saying, here's what the dollar is worth overseas. Inflation, what you're speaking on, like consumer price inflation, let's say, that's saying for someone who lives in America, how much is the price of a basket of goods that's determined by the Bureau of Labor Statistics to represent what an average American would be buying. What's happened with the prices there, and that's how they're measuring inflation.
And so the president wants to see the dollar drop even further against foreign currencies. And I presume the primary reason is because it makes it easier for American manufacturers to sell to foreign markets.
That's exactly right. So that's going to make our exports more attractive because it's going to be cheaper for a German or somebody living in Japan, let's say. But on the flip side of that, that's going to make our imports more expensive, right? For an American that needs to purchase a BMW or French wine. There you go. Let's not even get into tariffs, but just, thinking specifically about the value of a dollar, that's going to incrementally add to the cost of the things that we purchase. And some of those things will likely end up in the CPI basket, the basket of goods that are representative of consumer price inflation. And that would then directly impact our inflation.
Oh, and a trade war, too, with this tariff problem, the other countries are going to be imposing tariffs. To the extent Trump is saying, let's help exports, contrary to that, the tariffs are going to hurt exports because the other countries are going to be imposing tariffs as well. So,
have other presidents been fixated with lowering the value of the dollar like Trump is?
There certainly has been in the past in different political regimes, I would say, on both sides of the aisle. And I think the reasoning behind that, particularly in a global world, so let's think about like a U.S. corporation, right? So a multinational corporation that is based out of the U.S., they're probably going to get half of their revenue from international markets. So if I'm getting half of my revenue in euros, half of my revenue in Japanese yen, and I'm then translating that back into U.S. dollars, that's going to, I would say, quote unquote, artificially inflate my dollar earnings. And so that's going to help my corporate earnings growth and so make my stock more valuable. So that's a positive, I would say, for a weakening dollar for the corporate environment. And so whenever there's been presidents that have been maybe more focused on that, that might be a measure that they take. It also just kind of depends on where the dollar is currently. Keep in mind that the dollar has been extremely expensive, I would say, or it has appreciated a lot over the last 5 to 10 years. And so some would say that this is just kind of naturally getting back to an equilibrium.
What do you think the reason is that it's appreciated over that period of time?
Capital flows. So when you think about the capital markets, what I'm referring to is equity markets, bond markets, commodity markets, whatever they may be, real estate markets. The U.S. has been so attractive since the Great Financial Crisis. If you go to pre-Great Financial Crisis, the European market was about the same size, if not larger than the U.S. as far as the equity markets. We've more than doubled in size relative to the European equity markets. So that means a lot of investors overseas are pouring money into U.S. markets. And the U.S. Treasury market is the largest debt market in the world. And so whenever an investor wants to buy a U.S. asset, they have to purchase U.S. dollars. And so that's going to increase the value of the dollar.
Wow. Well, now you said you didn't want to talk about tariffs, but we kind of do because
Okay.
It's a little difficult to see how that's affecting the U.S. consumer since they seem to be on, then off. And it's difficult to believe that they are not affecting prices because if it costs more to buy something that's manufactured in another country, then a U.S. company making the same type of a product with furniture or whatever, it can now charge more. So doesn't that really lead directly to inflation or keep it at least 3%?
Academically speaking, yes. I mean, if you're increasing the related costs or the ancillary costs of an item, that somebody's got to pay that cost, right? Mm-hmm. Historically, it does eventually feed through to consumer prices. As we sit right now, wholesalers, corporations have borne the lion's share of those incremental costs, but they can't do that forever, right? I mean, these are for-profit companies. And so eventually that will get passed on more to the consumer. It's hard to say right now how much of that has actually passed on to the consumer, just because this has been so in flux. I mean, go back to April of last year versus where we are today. There's been 50 different tariff regimes in a matter of less than a year. So keeping up with it, you need a poli-sci degree. But the way that we're looking at it is it's being used as a negotiating tool, as a deal tactic, and sometimes successful, sometimes not successful. And where that shakes out, I think, depends on A, what the actual tariff rules or laws are, and B, who's actually abiding by them. Because a lot of these corporations, a lot of these countries are getting really clever with how they are exporting their goods and how they're importing goods in order to sidestep, get around tariffs, not in an illegal way, but potentially in a moral way.
You know, Dan, we're trying to keep politics not somewhat out of this hour and more economics, but you made a point that I think is valid about it's being used. It's been unstable, and it's been very unstable because it's being used for other purposes to put pressures on these other countries. But the history of tariffs is not a very positive history. You know, Smoot-Hawley. I mean, it hasn't been successful. It seems to me objectively, I think it's hard to argue that tariffs have been effective in the past. Mm-hmm. And I'm not trying to push you down back in the politics way, but do you view, you know, from your background, do you view tariffs as something that's effective? And you may say that's really outside your purview.
I would say as far as our purview is concerned, I wouldn't. The revenue that is received via tariffs for the trade-off of the trade relationships is not worth it. That it's not something that's incrementally worth the juice isn't worth the squeeze, is what I'd say. Now, the impending trade negotiations and what happens with the trade deals, that's yet to be seen. Does it do enough from a negotiating bargain chip perspective to make it all worth it? I don't think we can say yes or no just yet. But the immediate revenues that are received for the tariffs, yes, it's positive. But I would argue that it's not enough for the battles that it has caused.
Yeah, when you mentioned that the companies, at least initially, are bearing that cost or most of the cost, but can't continue, I would think that's going to happen. They're not going to continue. I mean, these are for-profit corporations that have fiduciary duties to shareholders. They're not going to keep bearing these costs, it seems to me. So.
Yeah, and it depends on consumer behavior as well, right? So when those costs actually do come through to consumers, do they buy California wine instead of French wine? Do they change their right, exactly. So how much of that actually shows up? And some of that might already be taking place. We talked about inflation briefly. Inflation hasn't increased since tariffs have come into effect. And so it hasn't gotten there yet. And I think, again, there's a couple different reasons. That's other countries being able to sidestep the tariffs. I think that's maybe changes in consumer preferences. I know that that's wholesalers and corporations bearing some of the brunt. Wow. So I think it's a mix of things, and it's really hard to dissect and differentiate between what is causing the inflation to stay subdued right now.
Can you give us an example? You mentioned that some corporations are trying to sidestep the tariffs by some way. How is that happening?
So let's say like a country like China or Canada that has pretty restrictive tariffs right now with the U.S., they might ship to a country that has less restrictive tariff policy, trade negotiations with the U.S. first. And then it comes from that country, and it's not directly from China or Canada. And so it's not effectively having to pay the same level of tariffs. Or maybe they add a production step in the process in a country that is going to be less impacted by trade negotiations with the U.S. And therefore, there's enough value add in that step of the production process that it's considered to be part of the trade negotiation with that country. Like you've seen, for example, Vietnam, their trading with the U.S. has exploded over the last year. And I think that's part of it, is that China goods coming through a country like Vietnam. So that would be another example. And then just looking at, delays in the actual effectiveness of different tariffs, trying to get ahead of those. So you're kind of stocking the supply chain, moving items ahead of tariffs in order to sidestep the actual tariff impact. So those would be a couple examples.
I think previous presidents had had used tariffs on particular goods like steel or
Right.
something, as opposed to putting them on a particular country.
Mm-hmm.
And it seems to me that this country thing is being, there are workarounds that they're able to do that probably fly in the face of what the president was trying to accomplish.
Sure. And I think keep in mind that it's still product by product, which makes it even more difficult because even with a country like China, you have different levels of tariffs on different types of goods. And so, like we've been able to come to a better understanding on like rare earth minerals or semiconductors from our side going to them, so there's bargaining chips even on the product level going beyond, the geography. So it gets, like I said, a little convoluted and you need maybe more poli-sci education than I have.
Dan, I was also a finance major before I went to law school at the University of Florida, but I'm not, so I'd heard the word tariff, but, tariff was not a word that really was in your mind much as we went through life until this year.
Well, the last 20 to 30 years, the U.S. and the globe has really benefited from globalization in that tariff levels were at kind of extreme lows, at least since the birth of the U.S. And there was a concerted effort of globalization with a lot of positives, some negatives as well, but a lot of positives. And so I'm not surprised at all that tariff wasn't in the vernacular, but we have seen some tick up in deglobalization over the last couple of years. And I think part of that was due to some concerns around what happened with COVID, with supply chains. That's, was the cause of a lot of the inflation back in 2021. You also were looking at national security concerns with access to be able to make vaccines and whatever else. And so I think that maybe started it, and then that wave has just been ridden into different policy regimes and different reasons.
Well, going back 75 years, the U.S. evolved after the Second World War as the manufacturing powerhouse of the world and made us the economic powerhouse, which then gradually evolved into us becoming more of an information management economy, which some people criticize, saying we just don't manufacture enough things in this country. I know the current administration is boasting about bringing trillions of dollars of investment back into the country, but really it's staying steady at about $1 trillion a quarter of investment because it simply isn't economically competitive to manufacture so many things in this country. But as this AI evolution begins to take place, and that relates to what you call the Magnificent Seven stocks. That's probably the main powerhouse behind the stock market, getting to 50,000. What is it, dollars or points? Gee, I'm confused. Anyway,
just ask Pam; she knows.
Doesn't that mean that we really don't need to focus much on manufacturing? We've had the strongest economy in the world without being a predominantly manufacturing country.
Yeah, I think there are certain, again, going back to supply chain economics and the national security interests of supply chains, some manufacturing probably does make sense to have here, so some reshoring or maybe nearshoring.
Well, that would be like the CHIPS Act that we had in the previous administration.
Exactly. Exactly.
Can't
right.
be totally dependent on Taiwan for them.
Right.
Yeah.
So giving Intel money, giving, recently the U.S. government has talked about and has taken stakes in public companies. So MP Materials is a company that comes to mind. But yeah, ultimately manufacturing is certainly expensive to do here in the U.S. You certainly have lower cost goods and, more importantly, labor in other countries. Is that a good thing that you're exploiting lower cost labor in other countries? That's arguable. But I think ultimately, as you have this growth of the middle class worldwide, which you've already seen in China to a large extent. So a lot of the low-cost labor is no longer in China, which was the first step in globalization, the most recent iteration, I guess, of globalization. But eventually you're going to move out of low-cost labor in the world. And so I think manufacturing takes on the idea of where do we do our manufacturing might be driven by different reasons in the future.
Yeah.
Let me ask you a fairly simplistic question. It strikes me that impediments to trade are generally a bad idea, that globalization of trade is a good idea, with the exception you mentioned of exploiting, people getting nothing working in Taiwan or somewhere. But I'm not sure why there seems to be this trend, at least in this country now, away from that general premise, which is globalization is good, trade is good, and yet we're doing things now, and I'm not asking you to get into politics, but we're doing things now that seem to me objectively to go against that premise.
So Europe is the cautionary tale. I mean, look at what they're dealing with energy prices because of their reliance on Russia. So over the last couple of decades, they really invested in, hey, we're going to move to renewables. We're done doing any drilling here. We're going to rely on Russia. We're going to run nat gas pipelines. We're going to get our energy needs from Russia. And then Russia invades Crimea, right? Back in 2013, Russia invades Ukraine. Energy costs skyrocketed in Europe. The economy still hasn't recovered. I would argue that part of the reason why the U.S. has been better off since the Russia-Ukraine war, and really since the pandemic, is because of our energy independence versus someone like Europe that is so dependent on a power that is, I don't want to say antithetical, but certainly against their own interests. And so it's those types of situations of at least the rhetoric that you'll hear of why, hey, we need to be focused on having enough control over our supply chains as we can, or having them with partners that we have no doubt are going to have aligned interests with us, which can shift over time, right? I mean, you go back to World War II, I'm pretty sure Russia was on the same side that we were. So things can change pretty quickly. And so I think, the conspiratorial view would be only your country. That's the only country you can trust. So I think we certainly can't get to that point, but there are certainly some industries that are of national security, vital interest that there should be more control over.
Well, let's pause for a moment to let you talk about ProVise management, the services you provide for your clients, and why somebody might want to walk into your office and do business with you.
Sure.
Dan Mannix, a senior investment manager for the firm. Tell us about some of the services that you provide your clients.
Yeah, absolutely. So we are really excited to celebrate our 40th anniversary this year, actually. August of this year, it'll be 40 years that we've been operating in and around the Tampa Bay area, based out of Clearwater, have another office in Tampa. And like I said before, we're a registered investment advisor that takes a fiduciary duty. So essentially, we believe strongly in the fact that just like you need a doctor for your physical health, you need a financial advisor for your financial health. And so it's really second only to physical health. And so we're doing everything we can to walk our clients through every type of life situation you can imagine, births, deaths, marriages, divorces, retirement, getting into the workforce. I mean, you name it. So our services include financial planning, retirement planning, asset protection, estate and trust planning. We even do retirement plan consultation for corporations. Some of our clients are business owners, and we'll help them with their retirement plans. Yeah. So we do a little bit of everything, but we have these financial planners that are certified financial planners, highest designation in the financial planning world. And they have that fiduciary duty to do what's in your best interest and to help you accomplish the goals that you have. Me, as a portfolio manager, with the CFA designation, Chartered Financial Analyst designation. I'm throwing a lot of acronyms at you. Also a fiduciary duty, responsibility to do what's in our client's best interest. I'm trying to synthesize everything that we're talking about here, plus a million other things, to position our clients to accomplish those goals that are being set out with the financial planners.
Yeah. And of course, you work with that whole team.
Absolutely.
To make these decisions
Yes.
on how to steer your clients into what's in their best interest,
Yeah.
not in what's going to make you the fattest commission. Isn't that?
That's right. We don't even use commissions. We are a fee-based RIA. And so we do better when our clients do better, like you hear the old Fisher investment.
I've heard that somewhere.
So, Dan Mannix, one of the urban legends I hear conservatives who don't like government tell us is that the government can just print all the money it needs anytime it wants to pay its debts. And I wonder how it does that. I mean, if the government could do that, why do we have any national debt? And if the government prints $1 trillion, for example, it's sitting there at the government printing office. How do they get that money into circulation in the first place, given that the era of an actual Social Security check showing up in somebody's mailbox is gone? Same thing with welfare checks. Everybody's working off of debit and credit cards. If you put a client into treasury bills, you don't tell him to bring $10,000 down to your facility to buy it. And when he gets paid the interest on that, the government doesn't put $350 in an envelope and mail it to him. And similarly, when that bill comes due, cash is not involved in that transaction. So first of all, is it true that the government just prints money to pay its bills? And second of all, if it does, how does it circulate it? How does it use that? It doesn't pay contractors or employees with cash anymore. Those days are gone. Mm-hmm. What's the deal on that? Is it an urban legend, or is it?
That's a lot.
How do they do it?
There's certainly some truth in that. So the government does print money to pay some of its debts. We obviously also have tax revenue. It would be the largest revenue to help pay debts. But yeah, essentially the way that it works is you have the U.S. Treasury. Right, so they will issue treasury debt. They are then paid by these large dealers or banks that have reserves at the Federal Reserve. And so their reserve levels will be, dinged for the issuance of the treasuries, with the largest buyer being the Federal Reserve. So the Federal Reserve is buying these treasuries along with foreign governments, pension funds, endowments, individuals across the U.S. and across the globe. And so the way that the mechanics work, the way that you print debt is by, or print money is by issuing the debt. Theoretically, there is a blank checkbook, but in practice, that's not the case, right? So there has to be demand. So again, the Federal Reserve is going to be part of that demand, but you're also going to have other buyers of this debt in order to, print this money. And so, for example, yesterday you had a 20-year auction, so 20-year treasury that didn't go too well. And so when there's not enough demand, what they have to do is sweeten the deal, right? So they increase the rate that you would get, the interest that you would receive by lowering the price. So you might try to offer it at $100, but there's no buyers at $100 or maybe not as much as you wanted. And so now you offer it at $99.
Why do you think it did not go well yesterday? Curious.
So the 20-year is a historically weird maturity. And so if you looked at what we call the yield curve, so if you just plotted the yields of all the different maturities of treasuries on a chart, starting from 1 month all the way to 30-year, the 20-year, there's like a little kink where sometimes it's higher than the yield you would get on the 30-year, which would be, it wouldn't make a lot of sense academically speaking, because as an investor, if I'm going to lend you money, the longer I lend you the money for, I expect a higher return, right? That's a longer period of time that I go without my money. That's a longer period of time that you could mess something up and not be able to pay me back. But for some reason, the 20-year doesn't do as well, so they have to offer it at a little bit of a discount. So that's just an example of a Treasury auction yesterday, but maybe not the best example because the 20-year is a little funky, I guess.
But even with $38 trillion of national debt, U.S. debt is still considered a secure investment.
It is the risk-free asset of the world. Yeah.
Isn't that unbelievable?
Even though we just got a downgrade, what was that, last year or 2 years ago? I want to say 2024, but we got another downgrade back in 2013, I believe it was. So there are credit rating agencies, three of them, three main ones. And so two of them now have dropped the U.S. debt from AAA highest rating down to one notch below. And yet it continues to be the benchmark risk-free rate because essentially, effectively, I guess everything is relative.
Now, the national debt with other countries, the three countries primarily, correct? Canada, Japan?
It's Japan, China, and the third country, it's probably either Canada or Great Britain. I'd have to see.
Yeah, I think it's Canada. But isn't there the risk, though, they could call the debt? Or is that just theoretical?
Treasuries you cannot call. So there are certain kinds of bonds that have a callable feature, but the call is held by the issuer, not by the buyer. So it would be the U.S. that would call the debt, but they can't because it's not a callable bond.
Yeah. So the only thing they could do is sell it to somebody else.
Exactly. You could sell it. And if everybody's trying to sell at the same time, then, supply demand, the price is going to go down.
Right.
Which effectively wouldn't bother the U.S. Treasury because you already got your payment up front, right? But what that does is that increases the yield or lowers the price if you have lower demand for that particular bond. As they continue to try to issue new bonds, they're going to have to offer higher yields or lower prices.
But the OMB continues to predict at least $2 trillion of additional debt piling up every year. I think, don't they forecast out 10 years and no more than that? Is that correct?
I'm not exactly sure on that.
I always see,
but it's not good. Those aren't good numbers. You don't like to hear those numbers. I guess the one saving grace is if we look at debt as a percentage of GDP, so debt is a percentage of our economy, it's been pretty stable. And so, yes, the debt's going up, but so is the economy. But you don't want to fuel all of your economic growth with governmental debt. That's not healthy. So longer term, it is certainly an issue and something that needs to get figured out in this country and other countries.
Yeah, because just servicing that debt has now become the top ticket item of the federal budget.
It's the fourth, I believe it's the fourth largest. So if you look at the mandatory funding, Medicare, Medicaid, Social Security, that's one block, right? That's more than, I think it's about 50% of the budget. The next item actually is larger than defense spending now, being interest expense. That's right.
And I don't think that the average person understands that, which I think the other effect of that is it just, what you're talking about is very little percentage of the budget is something that you can negotiate.
That's right. Discretionary.
Right, exactly. That's the word I was looking for.
So let's talk about Social Security. The trust fund now projected to be fully depleted by 2033. And it means that the government probably is going to need to make either an adjustment in the Social Security taxes, or it's going to need to reduce the distributions to beneficiaries.
Or increase the retirement age. That's really the only other lever you could pull, right?
Or a combination of all three.
Right, which is probably the answer. There's probably not a silver bullet. It probably is higher taxes, lower benefits, longer retirement age, or higher retirement age. So,
what about removing the income cap? Wouldn't that solve the problem?
Right, so that's another, falling under the tax category of just removing the income cap or increasing the income cap.
Describe what the income cap is.
So beyond a certain income threshold, which depends on whether you're single or married, you no longer pay the Social Security tax as a W-2 employee. Yeah.
So it's like 170 something thousand now
for single. That sounds about right. I want to say it might be higher than that for married.
So if
it changes every year.
So if you're a Buccaneer player that makes $6 million, then you stop paying into Social Security at 170,000, even though you make $6 million.
That's right.
Yeah,
that's right.
I remember it used to be even like 45, 50,000. Back in the day, I know it keeps going up, but it sounds to me like, and I don't, I'm learning a lot today, that it's going to be a combination, as you said, Ed, of those. Those are all pieces of a solution, I think.
Yeah.
I mean, you also have demographic issues with Social Security, right? That we have to tack on top. This problem isn't going to get easier, I think, going forward as you look at, the aging demographic of this country, which a lot of the developed world is dealing with. Japan and China being the two largest examples right now. But ultimately, you have fewer workers paying for more retirees. I mean, for myself, I'm 41 years old. I don't expect to get, at least when I'm thinking about my own financial budgeting, when I'm thinking about my retirement, when I'm thinking about my future, I don't expect to get anything from Social Security.
Really? Why? As long as somebody goes to work, somebody's putting money into the Social Security.
I think
system, right?
I think I'm conservative with my budgeting, trying to if I do get something, hey, that's a nice cherry on top.
Yeah.
But as it stands right now, as you just said, 2033. That's not very long from now. 7 years. I won't even be 50 yet.
We've mentioned there's a high percentage of the public that's their sole source of income is Social Security.
Sure.
They don't have any pension. They don't have any IRAs.
Yeah.
They have no savings. The point about working later, that is a reality to some extent. I used to be a circuit judge. The judges now used to have to retire at 70. That now mandatory retirement is 75. So there is some reality, I think, as maybe the health of many people seems to be, doing well, that
Sure.
people don't seem, I'm 67 and I still work. I don't feel like I don't feel like I had to retire at 65. So that part of it to me seems like that could be a decent part of the solution.
And the economy has changed, right? There's less blue collar. There's less physically demanding jobs and a lot more people sitting behind desks. So you arguably could work longer, I guess.
That's a good point.
Until AI takes away all the jobs, right?
Right.
Well, let's talk about those 7 stocks that
The
he
Magnificent
mentioned.
Seven, isn't that what you call it?
Sure, that's the name that they've been given. It's certainly something a term that we'll use, but the truth of the matter is that they are not the same kind of company. They're all very different. They're actually in different sectors. They're not all in the technology sector, and they're not the 7 largest stocks anymore, actually. But the original Magnificent Seven, yes, they all have some level of exposure to artificial intelligence consumption or production of.
Yeah.
Yeah. So last year, the Magnificent Seven, well, let's just say the top 10 stocks, because the Magnificent Seven has kind of flipped a little bit with Tesla falling out, Broadcom going in. So let's just say like the top 10 stocks in the U.S., they made up about 50% of the S&P 500 market returns in 2025. So of 500 stocks, you have 10 representing half of the return. But keep in mind that those 10 also represent almost 40% of the size of the market. These are huge, huge companies, behemoths.
Now, does China have a stock market? It does, doesn't it?
It does. China has they have a dual share class situation where there are shares that you can buy as a foreigner, but then there are shares that only Chinese people can buy and sell.
Okay.
But the stock market in China is much less mature than other markets. So when you think about China being the second largest economy in the world, it's shocking that their equity markets only make up, it's like 5% of global market cap.
Yeah.
So a very immature. The Chinese people are more invested in real estate, commodities. That they tend to have different, and actually all countries invest less in stocks than a country like the U.S.
Did they attain 10% GDP a few years ago, China?
Did they do what? I'm sorry?
Attain a gross domestic product growth rate of 10% in 1 year?
Maybe on the back of, a government shutdown with the pandemic. That's possible.
Yeah.
So all economic growth was juiced because we just turned the switch off. But they've been growing by about 5% over the last couple of years, which is kind of average for China.
And we stay at about half of that, about 2.5% in the U.S.
Yeah, we've been doing a little bit better than that recently. We've been above potential growth, and part of that is due to what we were talking about before in the monetary and fiscal stimulus of the government, helping to kind of juice the growth here in the U.S.
Yeah. So is there a danger of getting the growth too high in a year?
Absolutely. I mean, ultimately, you want to be careful about without getting too term specific here, but like your potential growth over what your actual growth is, or vice versa. So your actual growth being above what the economy should be sustaining is what's going to lead to inflation. So ultimately, none of us want to go back to 2021, 9% level of inflation. We'd like to stick closer to that 2% level, which we're not back to yet. And I would say is not going to happen this year or next year.
Then what is your thought about inflation of the next few years? Do you have a sense?
I think inflation is kind of in the sense of when you think of the food delivery business, the most difficult part of it is the last mile, right? They say that last mile is the most difficult part of the distribution setup and delivery of food. I think in the same sense with inflation, this last 1%, this last mile is the most difficult. And part of that is due to just the stickiness, the ingrained nature of the last parts of this inflation that we're dealing with, depending on the categories. The biggest one being shelter. I mean, that's the biggest, stickiest part of inflation at this point that we've been experiencing. And ultimately, it's really difficult to get down to a 2% level, which, by the way, is kind of arbitrary. They just kind of came up with, all right, we want 2% inflation. They thought that sounded like a good number. Not that it was a wet thumb in the air, but probably not too far off, at least in my opinion. But I think 3% is higher than we would like longer term. It's going to be difficult to get it down to 2% without labor, without employment coming down. Ultimately, it's hard to break the back of inflation without breaking the back of wage growth, which is not what you want to see. So right now, what we've got is real wage growth, which is important. Yes, inflation is going, steadily right now. I wouldn't say it's going up, but it's pretty steady. Wage growth has been higher than inflation. And so that's positive real wage growth, which is important. That's sustaining this momentum because consumers are 2/3 of U.S. economic growth. It's the money that consumers are spending. And so that obviously changes when people lose their jobs.
But now if Powell retires, or I should say when he retires and a new chairman comes in to the Fed, and if he lowers interest rates as the president wants him to, tell me if I'm right, that would first generate a spike in the economy that would then lead to a spike in inflation. Is that the way it would work? And is that why Powell has been reluctant to bring interest rates?
Yeah, so we lowered interest rates, 3 times last year? The we being the Fed, they're lowering short-term interest rates. It is kind of like a sugar high. It gives a boost, not only to the economy, but also to stocks and bonds. The Fed was expecting to cut rates once this year. The market is hoping for 2. Kevin Warsh has historically been pretty dovish. He was kind of Ben Bernanke's right-hand man back during the Great Financial Crisis, has a lot of great experience. But his tone recently is, I would say, been more hawkish. So it'd be interesting to see how all that works out. But keep in mind that Jerome Powell hasn't said just yet, but he can stay on as a board governor. This committee of 12 people that are deciding what the interest rate is going to be. He hasn't said whether he's going to stay on or not, but he could still be involved with those committee decisions moving forward. But we don't think as a firm that we need to cut interest rates. To your earlier point, the economy is strong. There's really no reason to try to restoke or reignite inflation with lowering interest rates, because essentially what you're doing is you're lowering the cost of things. You're lowering the hurdle rate to take on risk, which is what creates asset bubbles.
Is the cost of fuel a relevant factor in inflation? I ask that because it's come down about $1 a gallon over the past year, but prices have not followed.
Yeah, absolutely. So there are two measures that we look at with inflation broadly. It's either a headline inflation number or a core inflation number. So core inflation strips out food and energy because those categories are pretty volatile. So when you think about the Fed's 2% inflation target, what they're looking at is actually not CPI, which is what a lot of people look at. It's PCE. It's personal consumption expenditure inflation. Again, I'm giving you a lot of acronyms here. But that is the Fed's preferred inflation gauge, and they actually are looking at core when they're coming up with their target. So they're excluding food and energy when coming up with what they would like inflation to be.
Okay.
Us older folks remember in the 70s, inflation was 15, 16, 17, 18%. It brought down Jimmy Carter's presidency, among other things. And then in 2021, I mean, that I think, would you agree with me that number, you could explain why there was high inflation because of the pandemic, et cetera. And it seems like it's gone back to more normalcy now.
Yes. Yeah, and a couple of the major reasons there being the dynamics that were in place, the mechanics, I guess I would say, back in 2021 are really not there right now. They've been resolved. So you really had a classical supply push and demand pull inflation at the same time, which is not good. So you had supply chain bottlenecks, right? You had, companies, warehouses, manufacturing, industrial, all had to shut down, right? Nobody could work. So the supply chain got all jammed up. And then on the demand side, you were just giving people checks. And so you had people sitting at home. They couldn't go anywhere. And keep in mind, we are a services-based economy. That's where most Americans spend their money, is services. They couldn't do that. And so what are they going to do? They're going to buy a bread maker and learn how to make bread, or all these things that they weren't doing before. They were buying goods. Our economy, our supply chain was not set up to handle that level of demand for goods. On top of the fact that there was a supply chain shutdown, which you can't just flip a switch back on and everything just is working great. So there were a couple things in place there. Supply chains have eased. Those disruptions are gone. And then we're not handing out checks anymore. I mean, there is still some stimulus going on, particularly on the corporate level. Mm-hmm. And we will see on the consumer level this side with one big, beautiful bill act of probably the largest tax refund in U.S. history in April.
Wow. And is that anticipated to add to the debt, or is it presumed that that rebate will be spent and help reduce it?
So it depends on who you ask. But I would say the projections that I've seen is that it's going to add to the debt.
Wow.
It's going to add to the debt. So will it add to the economy as well in a way that offsets some of that? Sure. But I think from at least the projections that I've seen that it will add to the debt. So again, it's the short-term mechanic where the markets will react positively, but longer term stokes inflation, adds to the debt.
My last question is about today's current buzzword, affordability. Both parties claim they can make life more affordable. What can politicians do to actually achieve that? And maybe that's an unfair question to throw to you, but there must be something that they plan to do if they're talking about it.
That's a tough one. There are a lot of different components to that. We talked about earlier about shelter inflation being the largest, stickiest issue with inflation. That is probably where I would start. So we need to increase the housing supply, particularly affordable housing. So that is, the number one expense for most families, right? So I think that's where you have to start. So part of that is getting rid of some zoning restrictions and the fees that builders have to pay in order to get a permit on a plot of land. It's to a level where it doesn't make sense anymore for them to build a small 2-bedroom, 1-bathroom house, right? We all talk about, that was the American dream. And, in the 50s, you could buy a house when you were 20-something years old, and now people can't afford a house. It was a 2-bedroom, 1-bath, and it had no air conditioning and maybe no electricity. And it was, you can't build those anymore because it's just too expensive for these builders. So that's one thing, but there's a myriad of other things.
Well, in our final minute, tell us again about ProVise management and what you do for your clients and why your services are valid and important.
Sure. Our tagline is, that we're helping people navigate all of the circumstances that come up in life. I mean, there are so many events that we all go through, and we all have different goals, and it's not cookie cutter. We're all trying to do something different, and so we're all about financial advice for your life and your lifestyle. So, whatever you consider to be success, we're helping you navigate those things. We're coming alongside you like the doctor would on your physical health for your financial health. And if anybody wants to learn more, provise.com, PROVISE.com. Complimentary consultation if you want to speak with somebody to learn more.
Very good. And you're right here in Clearwater on Druid Street.
That's right.
Thanks a lot, Dan Mannix.
Thanks for having me.
Dan's a
Thanks for
senior
coming in.
portfolio manager with the firm. It's all the time we have for today, but we'll be back next Thursday with another edition of The Voice of Reason, and I hope you'll join us at 9 o'clock. I want to thank my two co-hosts, Gary Gibbons and Kevin Carey. I'm Ed Golly. I'll remind you, if the statement seems a little too implausible to be true, don't believe it just because a conservative said it.
Make them prove it.
You know it.